All right, what's going on, everybody? I'm Ron Sneller. Thanks for checking out the video today. Today, we're going to take a look at a case study from the Don't Worry, Retire Happy series that Tom Hegna put together. The last couple of weeks, I've been talking about the importance of fixed income sources like pensions, Social Security, and annuities. And then on the other hand, I've been talking about the importance of one's investment portfolio and how you should grow that to optimize the portfolio to protect against inflation. And so in some people's minds, they've always been taught that it should be annuities or investments, when really the optimal approach should include both. So today we're going to go through a case study where we're going to bring this all together. And I think that some of the confusion that people for 30 or 40 years of their lives, they're looking at retirement as the peak of this mountain that they have to climb. And so for 30 or 40 years, for most of their life, they are focused on working, saving, accumulating money, and trying to grow it for that day when they retire. Except when they get to the peak of the mountain, now the rules of the game change completely, because now they're no longer trying to grow their money for some day in the future. That day is here. So now the name of the game is distribution. It's creating enough income to cover all of our basic lifestyle expenses or our basic living expenses, but also our discretionary expenses to maintain our lifestyle. So the first step when we take a look at this is covering our basic expenses in retirement. So I'd like you to meet Joe. Joe is a 65-year-old retiree. He has a small pension, he's got Social Security, and he's accumulated $1 million in his IRA. Now, he wants to maximize his retirement and spend his money in the most efficient way, but also in a way that's going to protect him against the key retirement risks. So step one, when planning somebody's income portion of their retirement, is assessing the basic expenses. So for Joe, in this hypothetical example, Joe, his basic expenses, $60,000 per year or $5,000 per month. Now, Joe wants to live a comfortable, worry-free retirement. And so he wants that $5,000 per month covered with guaranteed lifetime income. So he'll never have to worry about paying his bills, no matter what happens in the financial markets and no matter how long he lives. So how do we go about doing that? Well, you can see on your screen that Social Security covers $24,000 of income. His pension covers $12,000 of annual income. And so for his basic expenses, we have a shortfall of $24,000 per year. That is his primary concern. And then, of course, on top of that, discretionary expenses, he'd like to have an extra $1,000 a month or so to spend just to have fun, enjoy his retirement, his hobbies, so on and so forth. So what we need to do is we need to apply his guaranteed lifetime income sources, such as his pension and his Social Securities. And then we need to take a look at the shortfall. So his pension and Social Security covers $36,000 of the basic expenses. So we have a shortfall of $24,000. So Joe has $1 million in his IRA. So what's the best way to use that $1 million to cover his basic expenses each month? Is it to pull it out of his stock portfolio, to utilize a bond fund, maybe to move that money to a money market or a CD? No, I don't think so. The optimal way, what all of the research has shown us, what retirees need and want much more than any of those products, are guaranteed sources of income on which they can depend every month. Again, I've already mentioned the pension and the Social Security, but it's quite possible that you, much like Joe, will need a third source of guaranteed lifetime income to cover all of your costs. So here's what we need to do. We fill in any shortfalls with a lifetime income annuity from a financially strong, A-rated insurance company. So what Joe's going to do here is he's going to take about $400,000 from his IRA assets and purchase the rest of the guaranteed lifetime income that he needs. So he's utilizing only 40% of his assets to secure an income floor. This strategy, it's called the flooring strategy. This will guarantee you steady paychecks for the rest of your life. And this is the optimal way to do it. Math, science, economics, all of the studies have showed us this is the optimal way to do it because no matter what happens, you are covered. This is the happy factor. And don't worry, retire happy. This is security. And the annuity payouts are much more efficient than any other method. Now, once we have our basic expenses covered with guaranteed lifetime income, and we have those paychecks rolling in from pensions, Social Security, and annuities, what next? What do we do now? Here is where we design a discretionary retirement portfolio to optimize your growth potential and to optimize your goals. Okay. We need to make sure that we're keeping an eye on inflation, and we need to provide for discretionary spending as well. So now that Joe's covered his basic living expenses with the guaranteed lifetime income sources, again, we need to maximize the remainder of the portfolio. Again, so discretionary income needs are met, and he wants to allocate his assets in a way that's just right for him and his personalized goals. So there are many tools out there that you can use with your financial professional to show and design an investment portfolio that's going to be just right for you. Again, our goals are kind of changing because now we're looking at distribution versus just sheer accumulation. But based on Joe's criteria, and again, this is a hypothetical example, things might look much different from you or for you. This is the example that's been designed, optimizing a retirement portfolio for Joe here. So let's take a look at Joe's asset allocation model for his discretionary assets. So you see the pie chart there. We're going to invest Joe's remaining assets, the remaining $600,000, 80% traditional assets, 44% U.S. domestic stock, 16% international stock, 17% bonds, and 3% cash and cash equivalents. Now you're going to notice that this portfolio is probably a little bit more aggressive than what most retirees normally have. And you're also going to notice that Joe is deciding that out of that investment portfolio, he's going to take a small percentage of it, 20%, and he's actually going to put that into his income annuity as well. Why are we doing these things? Well, number one, since an income annuity has a stated payout rate and no market volatility, and it can never run out of money, no matter how long somebody lives, by using an income annuity, guess what? That ensures that some of Joe's, even his discretionary income, is going to be guaranteed. And then why are we able to invest the rest of his portfolio more aggressively than normal? Well, guess what? Again, this is depending on his risk tolerance and his time horizon, but we can invest his other assets even more aggressively, which over time may yield higher returns. Why? Because all of Joe's basic living expenses are covered, and even some of his discretionary expenses are covered. So in the short term, in the next 2 to 3 years, if we do see some major market volatility and Joe's investment portfolio ends up going down, guess what? He doesn't have to worry. Why? Because those paychecks are still rolling in like clockwork. The S&P 500, it just went down 40%. Hey, no problem. Let's go golf the back nine. But as history has shown us, when you can add more time to your time horizon, it will minimize or it will lessen investment risk. So over a longer period of time, over 8 years, over 10 years, over 12 years, having his portfolio invested more aggressively could very well lead to larger growth potential. And down the road, what we do is maybe it's 8 years down the road, 10 years down the road, we take the profits from Joe's investment portfolio, we peel off those profits, and we buy more guaranteed income. Why? Again, because if Joe has $75,000 of guaranteed lifetime income coming in, 10 years down the road, after inflation goes to work, the purchasing power of that $75,000 is going to be reduced. That's why it's so important to have growth-oriented assets, even during your retirement phase, in order to combat the ravages of inflation. So when we look at this case study and putting it all together, just really briefly reviewing the key retirement risks, longevity risk, we've taken it off the table. Why? Because no matter how long you live, those guaranteed income annuities just keep kicking off cash flow like crazy. Well, what about deflation risk? If we enter some kind of recession or depression, prices go down, the value of money go down. Well, guess what? Those fixed income streams, the annuities, the pensions, they become even more valuable. So we've also taken deflation risk off the table. Lifetime income annuities do very well during times of deflation. Now, we've also managed market risk and sequence of returns risks because his near-term income, that money that he's going to need soon, it's not tied to the performance of the stock and bond markets. And we've also managed withdrawal rate risk because, again, with annuities and with pensions and with Social Security, this income lasts as long as you live. But finally, one of the biggest things that retirees do need to worry about, because of the longer life expectancies, the ravages of inflation eroding and reducing your purchasing power over time. And so we also have our investment portfolio optimized for growth to protect against inflation. And of course, within that investment portfolio, we also have liquidity there. Now, we have one other main risk that we have to cover in the Don't Worry, Retire Happy series, and that is healthcare and long-term care, which we'll discuss next week. So I hope that this was helpful to show you how you can combine fixed income sources with your investment portfolios, what the strategy behind that is to give yourself a guaranteed paycheck and a guaranteed playcheck, how to combine those two things, your income and your investments, so you can live the optimal retirement experience. Don't worry, retire happy. Thanks for tuning in.